A few weeks ago, it was requested by one of the viewers to have a look at the financials of WeBuild, an Italian industrial group specialized in the construction and civil engineering. They are responsible for many different projects all over the world, like creating metro lines in Denmark, expanding the Panama Canal, or building a hydroelectric plant in Iceland. If you also have a stock in mind that you would like me to have a look at, please post it in the comments down below, and I'll do my best to have a look at their financials as well later down the line. So before looking at their financials, I think it's important to realize that WeBuild is a construction company, and they are notorious for having very low profit margins and very cyclical earnings numbers. Of course, you have to realize that construction mostly goes hand in hand with the economy, and also their working capital expenses, which is a very big part of any construction project, are very much dependent on the state of the economy. So we're going to see some fluctuation in their financials, but this is nothing unheard of in the construction industry. So looking at the revenue numbers, what we can see here is a steady growth of 8% every single year. Starting at around 4.2 billion in 2014 when they officially merged and became WeBuild, all the way to 8.1 billion here in 2022. And I think it's important to note here as well that WeBuild acquired Astaldi, another Italian construction company, in 2020. So a big part of the revenue increase that we see here in 2021-2022 is in part due to the acquisition of Astaldi. Their earnings numbers have been growing about 5% every single year, which is quite good for a construction company. If I take their EBITDA number here and divide it by their revenue, we can see that they have a profit margin of about 7%, which is relatively low, all things considered. And we can see here that their profit margins are around the 10 to 9% here earlier in the decade, and it's reduced all the way to around 6 and 7%. So their profit margins are decreasing, they are becoming less optimized in operating their business, which is a bit of a red flag. But let's continue looking at their financials here. And we can see here overall that their debt level has been increasing in line with EBITDA. Of course, a construction company requires a lot of leverage because of all the manpower and materials that are required for any building project. But just having a quick look at their EBITDA and debt numbers, we can see here that on average it's about 4 times EBITDA. Now I do think it's important to note here that in debt I included their bank loans, but I also included their bonds, and I also included any leases that they still have. Most of their debt is coming from bonds, and those bonds are actually exchangeable for shares as well, at least most of them. So not all of these are actually straight up debt, but it's still a liability that's on their balance sheet, and that's why I included it in this debt number, because it's still something that they have to pay either with cash or by diluting their share count. We can also see that they've always had quite some cash on hand to cushion any blows. Of course, they do need some cash on hand to fund any additional project starts, so I think it's very nice to see that there is some cushion available here in case anything might happen. Their market cap on average has been decreasing by 3.6% every single year. Another red flag here. If you bought their stock in 2013, you would have lost quite a bit of your initial investment. Enterprise value is the entire value of the business, so it takes the market cap or the price on the open market itself, to which we then add the debt and we subtract the cash, and then we get the total value of the business. Because if a competitor wants to acquire WeBuild, of course they have to buy it from the open market, but they also have to incur the debt that WeBuild still has and all the money that they still owe to their creditors. Their EV/EBITDA ratio tells us how many years of EBITDA are required for them to buy back the entirety of their enterprise value. And we can see here on average they've been ranging around the 3.4 times, a high of 6 and a low point of 1.0. Looking at the net debt to EBITDA, like I mentioned, it's a bit on the high end, I think, of the multiple that we want to see, but I did include their bond offerings in this as well. Even though they don't actually have to pay that with cash, they can pay that with shares. What we can also see is they actually have plenty of cash on the balance sheet available for them to actually buy back a big portion, if not all, of their debt numbers. So even though these multiples are relatively high, they can easily reduce it if they wanted to. So I think when it comes to the risk of bankruptcy, it's a very, very low risk. So this then brings me to their cash flow numbers, and we can see here that their cash flow has been going up and down quite a lot, mostly because of the change in working capital. They had a negative cash flow in 2013 of 300 million, but they had a very positive cash flow in 2021. So, like I mentioned, it's a bit of a cyclical relationship here. Capital expenditure on average has been relatively steady. Now, of course, capital expenditure is everything that WeBuild needs to buy in order to keep operating their business the way they have been for the past 10 years. This means any additional construction equipment, any additional helmets, any additional company cars, anything they need to keep on running their business. So if we take that cash flow and we subtract that capital expenditure, we get the free cash flow. And the free cash flow is basically your pro rata ownership of the company. This is all the cash that's available at the end of the year to distribute to you as the equity owner. And we can see here that for many of the years, they actually had a negative free cash flow, which means they are operating at a loss. Like I always mention, with free cash flow, you can either buy back shares, pay a dividend, acquire competition, or buy back your debt. And if you look at their historic numbers, we actually do see that WeBuild has been issuing a steady dividend every single year. So you might be wondering, how do they pay a dividend if their free cash flow is negative so many times? Well, if we look at the next column, we get the answer to that. So we see that WeBuild has been steadily diluting their share count for the past 10 years, which means they've been releasing shares on the open market and selling them to dilute the overall pool. So if you bought a share in 2013 owning about 1% of the business, 10 years down the line, you now own only 0.3% of the business because they've simply been releasing shares on the open market, and with those shares, they've been able to finance their dividends and they've been able to finance their working capital, employees, anything for the business. So they've mostly been financing their operations by subtracting cash from these shareholders. And of course, that's one of the perks that comes with being a publicly traded company. You can actually utilize shareholder money. But if you keep on doing that for a long period of time, of course, it's a very unattractive investment. And I do think that's something that we see here as well. Like I mentioned, in 2020, they did a massive acquisition of Astaldi, and we did not really see that debt level move at all. It remained quite stable. So where do they get the money from? Well, they issued about 350 million shares. They basically added 60% of the outstanding shares into circulation in order to finance the acquisition. And we can see the 2 years after that, again, they've been diluting their share count quite heavily. So I think this is very much a red flag. They've been diluting by about 10% every single year, which means that my initial investment is going to be worth less and less the more time progresses. So this then brings me to the free cash flow per share. This is basically the amount of shares outstanding divided by the amount of free cash flow. And we can see here that for quite a number of years, their free cash flow has been relatively negative. Price per share, this is the price on the open market. In 2013, a price of WeBuild was worth about €5. In 2022, one share of WeBuild is about €1.38. A massive decrease in price, even though we saw a massive bull run for the most part of the decade. Up until 2020, the entire market was going up, but not WeBuild. WeBuild was steadily going down. Free cash flow yield is a bit all over the place, so I'm not really going to take this number into consideration because there are so many negative numbers here because of that negative free cash flow. So this then brings us into the business of trying to forecast WeBuild, which is very difficult because their numbers are fluctuating a lot. So let's have a look here at the numbers. We can see that they had a record EBITDA in 2020 of €779 million. Now this number has been coming down a little bit, so I'm actually going to take this number of 2022 as a starting point, and historically they've been increasing their number by 5% every single year. So what I'm going to do here to be conservative, because I do know that a lot of this growth is because of a massive acquisition that they did in 2020, which basically resulted into them having higher numbers, even though the value per share has definitely decreased. So I think I'm being quite generous when I give them an EBITDA growth of 3% every single year. After the first 5 years, however, I'm going to reduce this to 2% because I think 3 is quite generous and I want to be a bit more conservative with my estimates. I'm going to give them a market multiple of 3 times, which is about the average number they've been trading at for the past 10 years. Of course, there are outliers of 6 times and 1 times, but overall the trend is around 3 times, so I'm going to give them that as well. This gives me an enterprise value of about 20 million 10 years down the line. from which we subtract the debt, we add the cash, gives us still about a market cap of 19 million. Divide this by the amount of shares outstanding, and I'm assuming here that the amount of shares outstanding remain the same and they actually stop diluting their share count. I don't think they will do this, but this is also why I gave them an EBITDA growth of 3 and 2% and not of 5% to actually account for this change in share count. So this gives me an average share price 10 years from now of €1.90. For their free cash flow, I'm going through a very similar thing. I'm going to grow it by 3% every single year for the first 5 years and 2% for the last 5 years. I'm also going to attach a 10% free cash flow yield, which I'm grabbing a bit out of thin air because there's not much information here to go on. But I do think that WeBuild, with the margins that they have, should probably trade at double-digit free cash flow, so I'm going to give them 10%. This gives me a stock price 10 years from now of €2.33. Looking at the stock market itself right now, I can buy as many shares as I want of WeBuild for €2.04. If I take both my predictions of the enterprise value model as well as the free cash flow model, I get an average share price 10 years from now of €2.12. Simply looking at the price on the stock market itself, this will give me a compounding annual growth rate, a appreciation in share price of 0.4% every single year. But the moment that I include their free cash flow, as projected here in our free cash flow model, I expect an IRR, an internal rate of return of 8.8%. But I do want to make a very big assumption here. And my assumption is that their free cash flow is going to be positive or neutral, but never negative. And given their historic track records, we can see that their free cash flow on many occasions has been quite negative. So I think the projection that I give here is very, very generous to them, and I actually expect them to have some negative years. So I think the IRR that I gave here of 8.8% will probably be a lot lower the moment that you take into consideration that one off year will actually create vastly different numbers. And I think you have to take this into consideration. The moment that you buy a share in WeBuild, you are gambling a bit on what the company will do in the future, because there's not really a steady trend predicting anything. So let's see then what happens if the price goes up or comes down a little bit. We can see earlier in the year they had a share price of €1.20. Now if the price comes down again by 30% to about €1.50, I expect an IRR of 15% given the free cash flow projection that I gave them here. Now of course you have to take into consideration the moment this is negative again, we will see a IRR of below 10% even when the price comes down 30%. I always say on average the stock market returns about 10%, so I think considering the average returns of the stock market, I think WeBuild is a very risky investment to make, and I think there is just no steady trends to accurately predict their future earnings and their future share price. Thank you very much for watching. Don't forget to like, subscribe and all that good stuff, and I'll see you in the next one. Cheerio!